Hello my fellow freedom builders and welcome here to Building Freedom. My name as always is Hans Nielsen and I'm here to guide you into a more solid, stable financial future and to teach you a lot about investing. Today we're going to talk about investment risk. It is a topic that is often forgotten or misunderstood by investors, and today I'm going to touch on a lot of different angles on this risk issue. At the end of the video I am gonna teach you something that you should bring to your next meeting with your banker or your financial advisor so that you can make sure you are investing in the right vehicles in the future, so you are getting more wealthy when you get older. So hang on till the end. I'm gonna give you some gems there that you can use at your next financial advisor meeting. All right, let's talk about risk. The topics we're gonna talk about today is if risk really equals danger. We're going to talk about a lot about volatility, some risk of having large drawdown, and we are going to move into some statistical issues about standard deviations and a couple of ratios that make sure that we can that we actually compare apples to apples and bananas to bananas, because a lot of people are comparing different investments in completely the same level. They're taking a day trading forex account and comparing it to a bond investing account, even though that is not really possible. So we're going to look at how we can normalize the numbers from different investments so that you can compare to different investments and see which one will in the long run make me wealthier. All right. First of all, when we talk about risk, normally when people talk about risk, we are often thinking about something that brings us severe danger. And when I talk about investments, let's say I talk to my parents about them and they are not investors, so what they are concerned about is that I lose all my money. They are seeing risk as some sort of severe danger where I can end up going bankrupt. And yes, of course I can if I put all my money in one very risky investment, but I don't, and that's what we're going to touch on today. So risk doesn't really it's not really about danger, but when we are investing in the right way, risk is more an issue of volatility as to how much your portfolio, the value of your portfolio fluctuates up and down over the time span where you are invested. So let's have a look at S&P 500. Here we have the SPY, the ETF that covers the S&P 500. We have it over a very long time span of something like 25 years or something like that. As you can see, it has yielded us 600%, which is great. Who don't want 600%? I know I do. However, this is of course only 600% if we are very fortunate and get in right here and get out right here, because in the process here we are having some quite large fluctuations, and that is what is called volatility, and that is where the risk lies when you are investing. Because of course if you put your entire retirement savings in this account right here, and you needed them right here right now in 2019 December here, then everything was great and you're ending up with a good chunk of money for your retirement. But in the process, we see some quite severe drawdowns. And let's say, for instance, that you started saving right here in the end of 99 or beginning of 2000, and you put all your money into the account here. But then 3 years later, you got married and got a kid, and you needed the money for a down payment for a house, so you had to liquidate your account here. Then you would be down 50%. That is a volatility risk, because the overall market, the bias of the overall stock market, tends to be bullish over the long run. If you're buying a stock and holding it one day, it is kind of 50-50 the chance of ending with a profit. But if you buy a stock or a basket of stocks and you hold them over 10 years or 15 years, there's something like 98 or 99% chance of you ending with some sort of profit. So let's say you lost 50% here, and then you got a bit scared and you got married and kids and house and all that. And then you decided here, now you had some money ready again, you put them into the market, but a couple of years later, you were facing a divorce maybe. And you needed the money right now because your wife or your husband needed to have the money. So you had to go out of the market again, this time with a loss of 55%. So even though the overall bias is bullish, there is liquidity, and that is where actually a lot of the risk lies in the stock market. It could also be that you were very fortunate and you got in right on the top here in 2000, but you needed the money here somewhere around 2013 or something like that. And you could say to yourself, well, I was down a lot a couple of times, but I got out and break even. Yeah, did you now? Because there is another risk, and that is the risk of when you are holding an investment for a long time, you are facing the risk of inflation. And inflation is this thing that makes your money worth less by each year. So if you can buy something at $10 today, then in a year it might cost $10.20, meaning that you can get a bit less value for your money. And if you are holding the same investments, if you bought the S&P 500 ETF here around year 2000 and you held it for 13 years, yeah, you might get the same dollar amount out, but now inflation would have eaten away 25 to 30% of the value, meaning that you could buy 30% less food or pay 30% less rent with your money. So even though you came out and break even, you actually lost 30%, which is also a risk. So if you are holding a stock or a basket of stocks for a long time, I know that some stock advisors, financial advisors are saying that buy and hold is the only thing. And that can be true, but you need to buy and hold the right things. Because if you're buying some stocks here and holding them for 13 years and you're not and you haven't made any profit here, you have actually lost money. And of course, this could also be that the place you needed the money was right here, and then you would have lost money again. So even though there is what is called a bullish bias in the market, you can easily end up losing money because of these different risk parameters. Of course, some people say, I'm only buying high quality, old, well-known stocks. And if you're putting your money into just a single stock, you're facing a very large risk. And I know that you might think that, well, if I buy just one stock, but it's a good and solid household brand, then where is the real risk? Well, we could look at General Electric here. General Electric is a huge company. It has been around forever. But if you bought it here in the year 2000 and you wanted to get out now, you would have lost just around 80% of your money. Even though it is a household brand and all that, even large companies can easily lose money. And if you have been around in the stock market long enough, you might also remember a company called Enron, for instance, which was also one of the companies that people really thought were good and solid. And a lot of the employees in the company had put all their pension funds, all their retirement money into this one company stock. And that went to zero. So even large companies can go to zero. To mitigate some of this risk, instead of just buying one stock, you can of course buy a portfolio of stocks. And there's a lot of research done on that. And some of this research shows that, of course, if you only buy one stock, you can see here we have the portfolio risk. And if you are owning a few stocks, maybe one or two, then your risk is very high. You can see up here. But the more stocks you own, 10 stocks here, 20 stocks here, 30 stocks here, you decrease the overall portfolio risk. So that, of course, if the market crashes with 50%, your stocks are also going down. But as you can see here, if we draw here, we have the overall market risk. And when you are up to somewhere around 20 to 30 stocks, you have pretty much decreased your risk to a level that is the same as the overall market. All right, that was a talk about risk in the market and volatility risk. But I promised you something that you can actually use when you are investing yourself and to assess and compare different investments. And here we need to touch on a little statistical tool, and that is something called the standard deviation, and that's something we should use in a second. Don't be scared about this. You don't need to know the calculations. It's just so that you know what we're talking about, because standard deviations are mentioned a lot in different videos and books, and I just wanted to give you a brief introduction to it. You might know this so-called bell curve, and of course it is called a bell curve because of its shape. But let's assume that we have a lot of different data points here. That could be stock prices, or it could be test scores in math for 8th graders in the United States, or it could be measured heights of men in India, or it could be whatever you want. It is a universe of observations. We have a mean, an average here in the middle, and then you can say statistically that you set some limits out here. That is what is called one standard deviation. And when you calculate one standard deviation, you know statistically that you have just about 68% of all the data points within these two limits here. If you calculate what is called two standard deviations, you have a broader span, and then you know you have around 95% of all data points within these two limits. And again, three standard deviations, we have around 99.7 of all data points, and you can go out further out. These standard deviations are used a lot in financial theory, and they can be good or bad, but it is a good standardized tool to put into our calculations. You might know it from technical analysis if you know the Bollinger Bands. The Bollinger Band has an average, usually a 20-period simple moving average. That equals this midline here, that is the average. And then we have two standard deviations of each, on each side of this, and that is equal to two standard deviations out here, meaning that in between these lines we should have around 95% of all our data points. And if we look at the price, we can see that most of the day's data here are within these lines. Then sometimes we get a big jump in price, and that means that the volatility of the price or the stock here goes up. And we can see that the Bollinger Bands, they spread further apart, because now we need two standard deviations would be a lot further apart if we need all of the data, or almost all of the data, to be within the two lines here. We can also see down here we have one standard deviation, and we can see here as soon as it jumps up, the standard deviation needs to be bigger because it needs to include more data. All right, I hope that wasn't too cryptical explained, but that is just so that you know that one standard deviation or two or three tells us something about how much data is included and how much volatility there is in an investment. All right, let's have an example so it's not pure theory here. Here we have some sort of stock. It starts at $10 and it goes to $21. So we have a 110% performance profit here. But we can see that this stock is quite volatile. Let's say that this is per month 1, 2, 3, and so on. We have from month 1 to 2, we have a 50% increase, which is great. But then we have a 33% drawdown, and 33% more, and 40% up, and so on and so on. So this is quite a volatile stock. It takes some stomaching to live through these ups and downs. If we look at it here, we have the monthly performance. You can see from month 1 to 2, there is a 50% upturn here. Then we have a 33% downturn, and 33% more, and 40% up, and so on, exactly as I mentioned here. So this is the data. When we need to calculate the standard deviation, you use these data, and then if you want to standardize this performance number so that you can compare it to any other investment you could think of, we have a formula called the Sharpe Ratio. And again, you don't need to know the math about this, but the Sharpe ratio is basically just the average performance minus the risk-free interest. And when we're talking about risk-free interest, then in Europe anyway, right now, that is just around 0. Maybe in United States it would be 1 or 2% right now, but right now I'll just put a 0 in here because right now we have just about 0 or negative interest here. Then you take your performance minus the risk-free interest and you divide it by the volatility. So that means that we are taking the average performance per month in this upturn here, and we are dividing it by the swings, by how much it jumps up and down. And I'll show you later why that is important. But here we have around 6.5% on average performance each month. We have 0 in risk-free interest, and we have a standard deviation that I have calculated. You don't need to know why right now, but that is 26, which is rather high. And that means that we are ending up with a Sharpe ratio of 0.25, which is quite lousy actually. We want a Sharpe ratio at least close to 1. When the Sharpe ratio of an investment is 1, it tells us that the return we get is quite okay compared to the risk we are taking, the volatility risk we are taking over time. If we have here a Sharpe ratio of 0.25, it tells us that it might be a good return we get, but during the time span where we are getting this sort of return, we are taking a huge amount of volatility risk. So it is, of course, only if we are certain that we can get the 110% right here, and we know that we can get out here, then it might be okay. But again, we might go into the investment here and need to get out here, and again come in here and need to get out here. So the more volatile this is, the more jumps up and down, the more risk we take during the investment. All right, that is the Sharpe ratio, and that is one of the most used ratios when we are comparing two different investments. And I'll show you a live example just in a second. But having this Sharpe ratio actually means that we can compare a very volatile stock investment to an investment in government bonds, for instance. Because, of course, the government bonds over time, they would yield us less return per year. But we would also have a lot less risk, volatility risk, over the time span where we are investing in it. There's a little variation, you could say, of the Sharpe ratio, because right now the Sharpe ratio is taking into account all of the swings up and down. But actually, the swings up, we don't mind too much because we want our investment to go up. So there is another ratio that can be good to know. I'll not go into details with it today, but that is something called the Sortino ratio. And these are just named after the guys that invented them. But it is actually the exact same. You have the expected return here. You are deducting the risk-free rate of return, but then you are only dividing by the standard deviation of negative asset return, meaning that you are only taking the standard deviation numbers of the drops. So you are actually only seeing what kind of negative risk am I taking and not what kind of volatility upwards are there. I know it can sound a bit cryptical, but I will make a video where I am taking a lot more of these ratios, because there are 5 or 7 or 8 of them that can actually be okay to know about. But the Sharpe ratio and maybe the Sortino ratio can be okay to know at least. Another thing that can be good to know is, because right now we are only measuring the statistical number as to how much performance are we making compared to how much the investment jumps up and down. But a very simple one, because the other formulas here, you need to have some sort of calculation of the standard deviation. But here, the portfolio performance divided by the max drawdown can be a very good and easy little formula to apply. And the max drawdown, if we look at the stock here before, we are having a max drawdown from a top to a bottom before it starts go up again and making new higher tops. So here, if we start here, then at this point, this is our max drawdown. It goes from $15 to something like, let's say 7.5, meaning that we have a max drawdown at this point at around 50%. Then it starts to go up again, and we get a new drawdown, this time from, let's say, 18 to 8. Let's just say 18 to 6 here, just for the sake of it, meaning that now we have a drawdown at 67%, meaning that this is now our max drawdown. So it is the largest drop in your portfolio from a top to a bottom in the equity line. That is our max drawdown. So here we are taking our portfolio performance, our overall performance, let's say that was 110%, and we divide it by the max drawdown, and if that was 67%, we'll get a ratio of something like 1.5 maybe. And then we can compare that to another investment that might have a portfolio performance only at 50%, but a max drawdown only at 5% because it was a lot safer investment. Then we get a larger ratio, and we need to get a high performance compared to the max drawdown we have during the investment. Let's have an example of this. We are looking here, and this is a chart that I have copied a while ago from a website, and I'm sorry I didn't write down the name of the website, so I can't even put a source on, and I'm sorry about that. If you're sitting out there and this is from your website, you can just cite the source down in the comment section. But here we have two different investments. We have investment A and investment B, and as you can see here, they are both doing the exact same performance. They are both doing 20%. They're going from an index 100 to an index 120 over about a year. So basically, if we just look at the performance numbers, return pro anno here in percentage, they're showing the exact same. And if you were not savvy into looking at the financial numbers, you would just think, well, my financial advisor is offering investment A and an investment B. That must be the same because they're both making 20%. But if we look at the chart here, it is not the same, because one is moving in an almost straight line here, and you're taking almost no risk. No matter where you wanted to get out, you would get out with a profit if you started here. But the other investment is extremely volatile here in over time, meaning it has some big drawdowns. And if you started here and you needed the money here, you would lose money, or here you would lose money, or here, or here, or here. So there wouldn't be much time except from at the end and right here where you could actually end up in a profit. So let's look at it. The funny thing is here that the investment A, meaning the black line here, has a lower volatility. And the reason for that is that if we are drawing a line just through the points here, you can see that there are some ups and downs here. If we are drawing an average line between the black, through the black line here, the jumps up and down around the average are actually smaller than here. So here we have some larger volatility around a mean, around an average. But if we look at the maximum drawdown, the black line, the investment A, are having a 30% max drawdown, whereas the investment B is only having a 4.2% drawdown. So which one would we like to invest in? Well, if we look at the Sharpe ratio, you can see that the investment A are actually having a Sharpe ratio of just around 1, which can be a bit misleading here. It's not often that we see so much volatility here and with so small jumps from day to day, but maybe it could happen. But this is just for the sake of the example. So we can actually see that a Sharpe ratio of 1 is a bit worse than one at 0.85, because I personally would rather have this investment, even though that the day-to-day fluctuations were bigger than these ones. But when we compare to the return to drawdown ratio, you can see that the 20%, just have another drawing tool here. Here, the 20% we got on the green line divided by the 4.2, that equals almost 5. So we are getting 5 times the return as to the max drawdown we are taking. Whereas the 20% in the on the black line on the investment A should be divided by 30, which gives us 0.66. So you need to have more than just one ratio to look at. Because, for instance, the Sharpe ratio can be a bit misleading sometimes, and it can be manipulated a bit. So when we're looking at these, we shouldn't just look at the overall return. We should look at what is the max drawdown, what is the Sharpe ratio, what is the return to max drawdown, and then we get a better feeling as to how much risk do I actually take here. And you can have 3 or 5 or 10 different investment options put on paper, and you can look at them and you can see which one fits my criteria best. It could also be that the black line maybe even made 30% instead of the 20. And I might still think for myself that I would choose the green line, making 20% because I was taking a lot less risk. Now why, might you say? Because 30% is better than 20, isn't it? It might be, but of course there is a risk during the process, but there's also another thing I'll mention here, and that is that when you are investing, sometimes you get an option of using leverage, meaning that you can gear up your capital. You can actually use some of the bank's money to invest with. And if I could choose between these two investments, the black line, I would not dare to use leverage because a maximum drawdown of 30% is way too much for me. So I might actually only choose to invest half of my money in this investment and let the other half be in cash, because then I would have an overall maximum drawdown of 15% of my collected capital. But on this one, that is only down 4%, I might say to myself, well, I could leverage that 3-to-1 maybe, meaning that I am actually getting 3 times the volatility. So I could be down at 12.6%, because then the performance would be timed by 3, meaning I would get maybe 60% in return and a 12% drawdown. So if we can get 20% here, 20% here, but with a lot less drawdown, then I can start thinking about maybe using some leverage, maybe using some borrowed money to put into this investment, because I know that even in the worst case, we see a max drawdown of 4.2% here, and I could easily take 2 or 3 times that drawdown without feeling that I had to get out of the investment. So all in all, what we have been talking about here is the market risk, the volatility risk, and we have talked about this Sharpe ratio, the Sortino ratio, and the return to max drawdown ratio. I will get other videos about more ratios, because there are a lot of different ratios you can look at, and some of them are better than others. But we have been looking at investment risks from different angles. I promised you something that you could ask your financial advisor or banker when you meet them the next time and they are offering you some sort of new investment. And what I want you to ask them is that if they are presenting you with some very nice sales material, and they are, the papers are showing happy people and happy retired people and happy grandchildren and new cars and so on and so on. All of this is sales material. I'm not sure if you know it, but your banker or your financial advisor is not always a real advisor. They are actually also salesmen that needs to sell the bank's products. But what you need to ask them when they present you with something is that you want to know the Sharpe ratio, the Sortino ratio, the return to max drawdown. As I mentioned, I'll get you some other ratios as well. It could be the Kalmar ratio or the Traynor ratio, or it could be a lot of different things. But you need to ask them this. And if your financial advisor doesn't have the number ready for you, they are not really serious, in my opinion. So at least if you have these concepts ready in your head and you know what to ask, you can show your financial advisor that they need to up their game a bit when they're talking with you. They cannot just present you with some rubbish investing showing happy faces on a piece of paper. They need to do their homework and do their calculations. And in a lot of countries, in Denmark where I live, I know that some of these, at least the Sharpe Ratio, I'm pretty sure they have to write that in the paper somewhere, but not many customers know what it actually means. So next time, please confront your advisor with some of these numbers and demand of them that they know them, that they can use them, and if they show 5 different investments for you, you need this number put into some comparison matrix so that you can talk about them with your advisor. I am not a financial advisor, so this is purely for educational purpose. I hope this investment risk video made some sort of sense. If you have questions or comments, please comment in the comment section underneath the video. If you haven't done already, remember to subscribe to the video or to the channel, like the video, hit the bell notification. That way you will get notified next time I put a video up. That happens 2 to 3 times every week. I'm looking forward to talking to you again. Take care of your money out there. Talk to you soon. Bye.